Well, hello, my name is Paul Carroll, CEO of Efficient Wealth Management, a boutique wealth management practice in the Woodlands, Texas. As we know, the election results are in. The election was a week ago, and there's been a lot of conversation. How did this happen? Why did this happen? Who's to blame? Who's not? Obviously, we know the electorate chose President Obama with about a 2% popular margin. So it's a tight vote, not so tight in the winner-take-all electoral college. The Republicans held the House. The Democrats, of course, are controlling the Senate. What is the impact of this outcome on the market? One thing that's not well understood is that the market reacts to the unexpected. And by no means was this unexpected. Great resources, the Iowa electronic markets, there are other markets that price the probability of an outcome. And most of those markets priced a 75 to 80% probability of an Obama victory. So it's fairly safe to say that 75 to 80% of that outcome was already priced into the financial markets. And a week later, what we see in that the markets are pretty much flatlined after an initial emotional reaction, that those handicappers, those punchers got it right. Going forward, there are two major policy trends that are going to affect the United States. Higher taxes are on their way. How will they affect you? Will they be just on higher incomes? We'll brush over this briefly today, but we're going to do a whole separate video just on tax strategy between now and the end of the year. And the other major policy trend will be continued government regulation. In the near term, the uncertainty really revolves around what's known as the fiscal cliff. As the standoff between the Republicans and the Democrats take us close to a crisis, the impact will probably be initially fairly muted. I mean, again, there's no surprise. The markets know the fiscal cliff exists. If the fiscal cliff really, if we really do drive over it, the impact will be muted initially. I mean, yes, there'll be a large impact on taxes, but when people talk about a 5% hit on GDP, they're talking about over an entire year. So brinkmanship very possibly will take us over the cliff, but within a couple of weeks, we're out of it. We've had a good crisis, and hopefully the good crisis won't go to waste. Hopefully there will be some moderation, collaboration, or whatever it takes to make long-term changes that will benefit the outlook for the fiscal deficit. Right now, for about every $3 that the United States is spending, $1 is debt. Only $2 is taxes. Regardless of one's politics, that doesn't add up. More taxes, less spending, some combination of thereof is going to be needed to resolve this. So again, the fiscal cliff may do more good than harm. We don't really know. One thing that will affect you with this fiscal cliff is the estate tax is snapping back from a $5 million exemption to a $1 million exemption. Now, most pundits, most estate attorneys feel that the expected compromise will be a $3.5 million exemption. For a couple with a good bypass trust or good estate planning, that's a $7 million exemption. However, if this doesn't happen immediately, we may be a $2 million exemption. And so for that reason, if your estate planning is not current and well done, you're running out of time. You need to get with someone immediately. Most of the good estate attorneys are booked almost through the end of the year already. One tax that's very likely to come in, Social Security has a 2% payroll break that's been going on for the last year or so. That's not likely to be extended. It's not guaranteed that it won't be, but it's probable that everybody in America will see a 2% Social Security tax snapback. So we have coming an important opportunity for advanced tax planning. Again, I'll discuss it in more detail in my next video, but we have issues of tax location, tax diversification, tax loss harvesting, realizing capital gains before those jump for many people. The impact of all the uncertainty, the fiscal cliff, the initial emotional reaction of a lot of investors led to an immediate 3% drop in the market right after the election. we have reviewed for our clients and, where applicable, rebalanced every single client in the firm within 2 days of the election. We have the technology that we can do that. If you haven't done this, this is something you might want to think about. From our point of view, that meant easy pickings. There will be more instability. There will be more emotional moves that will allow us to harvest losses and for the right clients, even purchase at bargain prices going forward. Further uncertainty will present opportunities to harvest volatility. Now, historically, markets do well in the 2 months after an election, and there's really no compelling reason to change strategy based on an election outcome that is already pretty much predicted by the punters and was mostly priced into the market long before this election, really. The United States is in a fiscal straitjacket, but the concern is that a flight to quality, which I would define as a flight to government bonds, may in fact just substitute inflation and interest rate risk for volatility risk. We're sadly in an investment environment where you can run but you can't hide from risk. It is very important that you stick with a well-considered plan wherever you got it. I hope that you found this information to be of value today. If so, please feel free to forward it. I look forward to talking about specific tax opportunities in the next video in the next couple of weeks. Thank you very much for your interest.